people, welcome back to my channel. My name is Adesola. You can call me Sholz. If this is your first time on this channel, I want to say welcome to you. You can check the description box to see my first video on what this channel is all about. So today we'll be talking about something very interesting. A friend of mine called me some weeks back and he was like, "Oh, Sholz, I have some money I want to invest and I want this money to double in 2 weeks." I was like, sorry, you've got the wrong person. I was like, "Oh, I'm sorry, I can't, I don't know how to do that. You know, I don't do Ponzi, I don't do any get rich quick scheme thing. No, I don't want that." And he was like, "Okay, so what do you advise?" And that is what we are going to be sharing today. So today we're talking about investing. So I'll be starting a series on investing, what it means to invest, the different asset classes you can invest in, and how you can invest, and we'll be demonstrating how you can invest by yourself. Yes, it is something very, very easy. So if this interests you, kindly stay tuned to this channel. You know, just hit that subscribe button and press that notification bell so that you always get notified whenever I upload new videos and new episodes. On this episode today, we'll be considering some things. We'll be considering what it means to invest, different investment opportunities, what you should consider before investing, what a portfolio is, how to diversify your portfolio, and ways you can make money from buying shares, and also how much money do you need to start. So what does it mean to invest? Yes, investing has to do with putting your money to work. Yes, you heard me right. When you put your money to work, I mean putting your money into different assets or different asset classes, and then it generates returns for you over time. So don't be scared. I'm not going to be using too many terminologies or complex words. No, I'm going to be simplifying it as easy as possible for you to understand. So investing has to do with you putting your money to work and putting your money into different asset classes that will generate returns for you over time. Remember, the purpose or the goal of your investing is for you to grow your wealth or grow your income over a period of time. So rather than you just putting your money under the pillow or in the bank, and some of these banks, I mean, you just be seeing them deducting one charge or the other. You just wake up one morning and then you just see one charge is already making your money come down and all that. So but investing has to do with putting your money to work, so your money grows and appreciates over time rather than just sit idle. And you want to agree with me, I mean, the prices of things last year is not what it is today. If you're someone that goes to the markets regularly, you would know that what you bought last year is not the same as it is today. So if you had kept your money under the pillow this same last year and you are coming back today to still pick up that money is still the same. So what I'm trying to say is that investing helps you to grow your wealth. It helps you to grow your income over time. So are you wondering, what are the different opportunities or the different areas I can put my money into? You can put your money into different asset classes like stocks or shares, as is popularly known. You can put your money into shares, you can put your money into bonds, you can put your money into real estate, you can put your money into mutual funds, you can put your money into commercial papers. We are going to be talking about all these on this channel. So picking them one by one, what are stocks or shares? Shares, when you buy shares, you are buying into a particular company. You are buying part ownership into the company, and so you are entitled, whenever the company declares dividend, you are entitled to dividends from that company. So however, one thing you should know about stocks is that the prices fluctuate. So the prices can either go up or go down. But the beauty of it is that once you are able to leave your money for a long period of time, you are going to definitely benefit from it. And then you don't panic. You're not always skeptical. "Oh, what's my money? I mean, just calm down. It works for you to be patient when it comes to stock. So the second one is bond. Yes, These are debt instruments that are issued by the government, and even some companies, some corporates, do issue bonds. It's a way of borrowing money. Yes, you heard me right. Even the government of Nigeria or government of any part of the world, they do borrow money. So you can even lend to the government or borrow the government money and still get returns from it. I mean, that's so good. So the third one I'll be talking about is real estate. Yes, these are properties. You can invest in properties. So in real estate, you can either make rental income when you lease out, and then you rent them out, and then you get rental income, or maybe leaving those properties to appreciate for a long period of time. It can be an industrial estate, it can be a commercial estate, it can be a residential estate, it can be anything, as long as you just invest in real estate. And it's also a very good way of making money. So another one is mutual funds. So mutual funds is a way of pulling money from different investors and then investing in diversified assets like bonds, stocks, and all that. So you can also invest in mutual funds. So the last one I'm going to be talking about, which is the last but not the least definitely, is commodities. So you can invest in commodities, you can invest in physical goods or tangible products like oil, like gold, like agricultural products. So I mean, there's so many areas you can put your money into. So now that you know what investing means and different areas you can put your money into, so what are the things you need to consider? You need to consider some things, some very vital things before you make investment decisions. So the first one is, what is your objective? Why exactly do you want to invest? Do you just want to keep your money safe? Do you want to keep your money safe? You want to keep your capital safe, and then you should just be getting some little interest over time, and just you are very sure your money is safe? Or you want to invest, you want to take on some risk to invest in different assets that can give you more returns, or you want to just put your money into assets that you can easily convert into cash. I mean, you want to put your money into something that is highly liquid, something you can always easily convert into cash. Your investment objective determines where you invest. So if you are someone who wants to preserve your capital, I mean, the federal government bond or bonds generally is a good go for you. And if you feel you want to take on more risky assets, you can go into equities where the prices can go up or down at some point, and then but over time you are sure that it is still growing your wealth. Another thing you need to understand before investing is your risk tolerance. Yes, your risk tolerance. What's your risk tolerance? So what does it mean when you say risk tolerance? It's not far-fetched. Generally speaking, the higher the risk, the higher the returns. So if you are someone who have the ability to tolerate more risk, you have the tendency or the potential to get more returns. There are different categories of risk tolerance levels. You can either be a risk lover, or you can be a risk-averse person, or you can be a risk-neutral person. So a risk-averse investor is someone that prefers to keep his capital safe while getting just minimum returns or just little returns, steady returns over time. A risk lover is someone who is willing to take on more risk in order to get more returns or better returns. So a risk-neutral person is someone who is indifferent when it comes to risk in his investment decisions. So you need to understand your risk tolerance level before you make your investment decisions. This will help you and guide you into which particular asset class you need to put your investments into. So let me ask you, what's the risk tolerance level? Yes. So what's the risk tolerance level? Are you a risk lover, or are you a risk averse, or are you a risk neutral person? Please let me know in the comment section below. Another factor you need to consider before making your investment is age. Yes, age. I mean, investment decisions, you don't just jump into investing. You have to understand how old you are. So for someone who is in his early 20s, he can still afford to take on more risk because it still has a longer period of time to live. You can take on more risk by going into stocks and just playing around the stocks, because you know that even if the prices go up and goes down, you can still always get your returns. So there is an old rule that says that you should be holding a proportion of stocks in your portfolio that is equal to 100 minus your age. So if you are 30 years old, you should be holding 70% of stocks in your portfolio. I don't know how true it is, but the truth is that it is always believed that the younger generations have more appetite, or they have more they are more risk loving than older generations. Some people believe that those that are older, they just want to keep their capital safe. They are skeptical whenever it comes to anything that will make them lose their money. I mean, that's very, very understandable. So the truth is that your age also determines your risk level. Having said all this, what is a portfolio? As an investor, you need to understand that you need to have a portfolio. And so a portfolio is like a collection or a basket of all your financial assets, like stocks, like bonds, like real estate, like mutual funds. So how much do you apportion to each of these asset classes? So if you, like I said earlier, even your portfolio is determined by your risk tolerance. So if you are someone who is a risk lover, you are willing to take on more risk in order to earn more returns, you would have more of stocks in your portfolio than other assets. And if you are someone who is a risk averse person, you would have more of bonds or fixed income instruments in your portfolio. So a portfolio generally is a collection or a basket of all your investments. So how do you diversify your portfolio? It is very important for you to diversify your portfolio. Do you know why? As the old adage says, it is not good to put all your eggs in one basket. Yes. Don't put all your eggs in one basket. Yes. So because, there are different economic times, there are different things that can happen to one stock or one thing. So it's better to do what? To diversify your portfolio. When I mean diversify, is for you to what? It's for you to spread your investment. So there are different ways you can diversify your portfolio. You can diversify your portfolio into different assets, like having a proportion of stocks, having a proportion of bonds, having a proportion of real estate, and all of these proportions will make 100%. If you want to put 50% into stocks, or you want to put 50% into stocks, you want to put 30% into bonds, you want to put 20% into real estate, this is what diversification means. And this diversification has to do with your risk tolerance level. It's all about risk. So if I see your portfolio, I'll be able to know that, oh, this person is a risk averse person, or this person is a risk lover, or this person is a risk neutral person. So you want to diversify your portfolio into different asset classes, like earlier mentioned. You can put them into bonds, you can put them into stocks, you can put them into real estate. These are ways where you can diversify your portfolio. Another way to diversify your portfolio is to diversify your portfolio into different sectors. So for instance, when investing in stocks, all the companies listed on the Nigerian Stock Exchange, or now they've changed their name to Nigerian Exchange Group, all the stocks that are listed on the Nigerian Exchange Group, they are categorized into different sectors. In my next video, I'll be showing you all these categories. They are categorized into different sectors. You have those that are categorized into financial services. You have those that are categorized into industrial goods. You have those that are categorized into consumer goods. You have those that are categorized into the healthcare. All these are different categories. So you want to diversify your investment into different sectors. Do you know why? Because you want to minimize risk. If you put all your investment into a particular sector, you are exposing yourself to a higher risk. So basically, the idea is that if you put all your investment into a particular sector, for instance, you put all your stocks into the financial services, into banking sector, what if anything happens to the banking sector? And the way stock market works is that generally investors are moved by different economic situations, or global events, or national events. Anything can happen anytime that can affect the prices of stocks. The prices of the stocks can either go up or go down. So you want to make sure that you diversify your portfolio into different sectors so as to minimize risk. So you want to be sure that your investment is diversified so that whatever happens in one sector does not affect another sector. And even when one sector is down, the other sector is able to help cushion your overall investment. So if you have your portfolio diversified into like 4 or 5 different sectors, even if one sector goes down, the other sectors are able to cover up for the sector that is down at that particular period of time. So to put this into context, imagine what happened during the time of COVID in 2020 when we had global pandemic and a lot of businesses suffered. Even though we had some other businesses that really thrived, we had some businesses that really suffered for it. The businesses that were involved in let's say tourism or real estate or hospitality or aviation or transportation, where there was practically no activity, they will definitely see their profit going down, and the ability for them to pay dividend at this period will be very minimal. So it is very important that you understand that when you are considering how to structure your portfolio, you structure your portfolio into different sectors, into different asset classes. In essence, the idea of you diversifying your portfolio is to ensure that you don't put all your eggs in one basket. While some will be like, oh, how about those businesses that were involved in remote platforms like Zoom, or that were involved in telecommunications where people could not reach out their family, so they were forced to always recharge, and go on social media and all that. These businesses thrive during this period. So that's why it is important that you need to diversify your portfolio so as to get good returns and minimize your risk as well. Let's talk about stocks or shares. Yes, so what are stocks or shares as it's popularly known? It involves buying part ownership into companies. So if you say a company like for instance, say Access Bank or GT Bank or MTN or Airtel or Zenith, do you know that you can also be an owner of this company? Yes, you can invest in that company and also be an owner. Yes, I mean that. You're wondering what's the difference between stocks and shares? It's not far-fetched. Stocks has to do with the totality or aggregate of all the shares that has been issued by that company, while shares has to do with individual units, of ownership in that company. As a shareholder, you are entitled to voting rights on corporate matters on that company, on some corporate matters, and also you are entitled to dividends. So if the company makes profit for that period and they pay dividends, you are entitled to dividends, from that company. So are you wondering, why would a company like Access Bank or GT Bank, why would they want to issue out shares? Why would they want to sell out a part of their ownership to the public? Yes, they do this for several reasons. It can be because they want to expand their operations, so they want to raise more money, they need more capital, and so they issue out shares. Or they want to invest into new projects and then they need more money. Or it can even be because they want to pay off some debt. So as a shareholder, you have a proportion of ownership in that company you are investing into. Investing in shares can be very rewarding. I mean, highly rewarding, especially when you have a long time horizon. So when it comes to investing in stocks, you need to also understand some things. You need to understand your risk tolerance level. Investing in stocks, the risk comes because the prices can either go up or go down. But the good news is that when you are investing in stocks and you have a long time horizon for it, you can benefit from it so greatly. Also, when you want to invest in stocks, you need to understand that you need to diversify. I earlier mentioned what diversification means. It means not putting all your eggs into one basket. So you need to understand that when you are investing in stocks, don't put all your investments into one particular sector. Another thing is you need to understand that you need to stay informed. While you don't panic, you need to stay informed about what is happening to your investment. In subsequent episodes, I'll be showing you how you can, stay informed, how you can keep tab of your investment per time. So, have you subscribed? So that's why you need to subscribe. Yes, you need to subscribe so that you'd always get that notification whenever I upload new videos. So are you wondering, how can I make money from stocks? Yes. So there are two ways you can practically make money from stock investments. So you can either make money from capital appreciation or dividend income. So by capital appreciation, it means that when you buy shares and then you leave it for a particular period of time and the price of that shares increases, it means that the value of your investment also increases. So let's say you bought a particular stock for 10 naira last year and it's selling for 20 naira per share today. It means that the value of your shares has increased, by the difference between how much you bought it and how much it is currently trading at. When the prices rise, the value of your investment also rises, and then you can realize this gain by selling it. So you can either sell it and then realize your gains or your profits, or you leave it for a long time for it to continue to grow. The second one is dividend income. So depending on how much profit a company makes, when you buy their shares and they make profit, they usually distribute a portion of that profit as dividends to shareholders. So you are entitled to that dividend per share. So let's say you bought 10,000 units of a particular company as shares, and the company is declaring 5 naira as dividend. It means that you have 5 naira times your 10,000 units, which makes 50,000 naira as your dividend income for that particular period. So that is how dividend income works. Are you wondering if you need millions of naira to invest? No, actually, you just need to know what particular shares you need to buy and how much quantity or volume of these shares you want to buy, and that's it. So in my next video, I'll be demonstrating how you can actually buy and sell shares. Yes, how you can buy and sell shares and the platforms you can use to buy and sell shares. We'll also be navigating the Nigerian stock exchange and the sectors you can invest in. And we would also be talking about the sources where you can get the right information for your investment. Is this of interest to you? I mean, does this interest you? Then hit that subscribe button and also press that notification bell so that you will always be notified whenever I upload videos. Thank you very much and catch up with you next time.